Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, January 17th, 5:13 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market in an uptrend with caution, however, as we still haven't decisively cleared the 200-day moving average, and we've been up until today we were up 6 days in a row. So just saying uptrend, it doesn't mean to just pile into the market after essentially being up 6 days in a row. Certainly some caution. It's not time to put the pedal down to the metal at this point. But stick with us on the videos, and we'll guide you with what we're doing based on our outlook in the market, what the internals are doing, what leaders are doing, what the indices are doing, and how things are rotating. And check in with us every day. We want to be your guide to the markets as we put a lot of work into keeping our finger on the pulse, and we pass that on to you in these videos every night. So state of the market, I'm sorry, the trend gauge over here, leaders bullish. Short term, all 5 moving averages above their short-term 21-day moving average, and the slope of the line is up. Medium term, above the 50-day moving average. Also, we've got some flat slopes for some of them. And long term, we are working towards solidifying a rally above the 200-day moving average at a huge resistance area currently, however, and we can't get the NASDAQ 100 over as it's been lagging for a while. But if you look at the equal weight NASDAQ 100, all of your fear and trepidation melts away as it's been acting much better. So what happened today? Mixed close, healthy consolidation slash rotation. Uh, we were due for this as we basically, as I said, have been up 6 days in a row. This is our 7th day above the ADMA and the 21-day moving average on the S&P 500. And time for some sideways action, some rotation, and that's what we got today. No major damage. As far as I can see anyway. G6 positive on the day, up 0.4%. S&P 500 made a new recent high, but rejected at that high and reversed and closed back below the 4,000 level, but still above the 200-day moving average. However, that can be a little misleading because the 200-day moving average is still sloping lower by about 3 points a day. NASDAQ 100 led up 0.2%. Tesla led there, up 7.4% within the NASDAQ 100. Dow got hit pretty hard today, mostly because of Goldman Sachs, which is the second highest weight. Remember, the Dow is a price-weighted index. Goldman Sachs, negative reaction to earnings, although it did finish off the lows down 1.13%. That just goes to show how one heavy weighting with one bad day can really skew the returns on the Dow. And Travelers, TRV, warned about recent excessive claims that hit the Dow a little bit also. Mid caps down 0.2%, Russell 2000 down 0.15, Global Diversified 60/40 barely in the positive. In-house GROTECTION, we were down 0.28%, mostly because of that 10% size in the Dow Jones Industrial Average that we had led to the underperformance. So let's dive a little bit deeper, and we'll start with what we do at Revere Asset. We are trend following active managers. Our flagship portfolio is named GROTECTION. That's a combination of growth during uptrends and protection during downtrends, and many varying degrees in between there, depending on the health of leadership and the health of the overall markets. When we're trending above all 3 moving averages, we are as long in the market as we comfortably can be. If things start to weaken a little bit and we break below and the slope of the lines of the moving averages, particularly the 21 and the 50, start to roll over, we will start getting defensive. Our sell stops will take us out of the market. If we really start to head south the way we did a year ago this time, January, when we broke below the 200-day moving average, this is when we really kick up the defensiveness, because our number one job is to protect our clients' downside. especially if you're headed into retirement. You do not want to face a negative sequence of returns scenario that could, uh, in a short period of time, derail decades of saving. So for us, downside protection is job number one, and then the returns take care of themselves when the market gets back to a healthy posture. And if you're interested in this approach, give me a shout, Don at revereasset.com, or my partner, Dan Stewart. He's the head of onboarding. Answer any questions that you have. That would be Dan at revereasset.com, or you can call 855 Real Wealth. That's 855 732 5932. So here's the S&P 500. Let's go to 30-minute chart here. And you can see here, starting on January 6th, the basically 6 straight up days. 1, 2, little consolidation in there. 3, 4, 5, 6, and then little sideways action at the top here. Kind of as expected. Don't go straight up in the markets. When you do, you're due for a pretty big sell-off as you get just too far to the upside. It's like a rubber band effect, works the same way to the downside. You stretch the rubber band too far, it's going to snap back. So here's the black line, the 200-day moving average. As I said, it's dropping by about 3 points a day. We got above it, excuse me, last Thursday and Friday, closed the week above it. Got to that 4,000 level today, which is a key psychological level. And there's also 2 big Fibonacci areas. When we get to the tail of the tape, we'll talk about those. We got up to 40.15 today and reversed lower. So let's go to the 5-minute chart. You can see some of the intraday volatility. All in all, it was kind of a tight range day, though. Basically 30 points, less than 1%. So opened just barely positive, little attempted to sell off, shot up to 40.15, negative reversal all the way down to 39.84, and then the rest of the day was contained within this low 39.84 and 4,001 going sideways. Tried to sell off into the close, but we bounced the last couple of minutes. So really, as I said, a healthy rotation consolidation day. Some of the recent sectors that have led sold off a little bit, like biotech, gold and silver miners, base metal miners. Solar continued higher, even though First Solar had a negative reversal. So some things that outperformed, just some rotation going on underneath the hood today, and all that rotation takes place within the S&P 500, which is why I'm so fond of using leveraged ETFs with the S&P 500 when the trend is my friend. So there's the S&P 500. Let's go to the NASDAQ 100. Multiple closes above the 50-day moving average now. 50-day slope is flat. You've got the 21 and the 8 trying to come up through it. That'll be a positive, but still 4.7% below the 200-day moving average. But like I said, if you bring up the equal weight NASDAQ 100, uh, if you went by this, then all of them would be above the 200-day moving average. But that's kind of manipulating the data to meet your narrative, and we don't do that. We'll point out what's going on, but really, you can't go by the Nasdaq 100 sometimes and the equal weight Nasdaq 100 other times. But the bottom line is that it's been these big tech leaders that led the rally, led the market for such a long time, just coming back to earth. Some of them trying to rally now, but a bunch of them really got taken to the woodshed, and the Nasdaq 100 is paying for it, and so is the XLK, XLC, and XLY. Those are the sectors that contain those big tech stocks that underperformed, and that trickled over to the S&P 500 because of their heavy weights in the S&P. And of course the Nasdaq 100 because it's a tech-heavy index. So let's go to the Dow, the one that got hit the hardest today. Still looks fantastic. Relative strength lagging, which is expected. High beta is actually by far outperforming low volatility this year. High beta up 10%, low volatility up only 1%. So there's the pullback around this 34,000 area, still above the 8, the 21, and the 50, and all the slopes of those lines are going higher. You can see the slope of the 200 still heading lower. Mid caps, MDY, been acting very well lately. two recovery highs. Well, let's just say highs going back to August anyway, and another tight range reversal extended from the moving averages. Not a surprise at all with that behavior. Same thing with IWN, um, IWM, small caps. High of this after this 6-day straight up move reversal, just consolidating tightly at the top. Notice the stochastics are getting overbought. We got to watch for a hook down here. They can stay overbought for weeks at a time. You can see back here when we rallied hard back in July, August, they stayed overbought for 3+ weeks. So just because you get into overbought doesn't mean that you have to start bailing on stuff. You might want to throttle back on new buys if you're under invested. But we always talk about going for the lowest risk entry points. And as long as you do that with reasonable stops, you'll be fine. In a bull market, overbought stays overbought. If you're in a strong bull market, so you don't even really pay as much attention to the stochastic. It's more in a trending market that you have to pay attention to it. So let's go to the RSP. This is the equal weighted S&P 500, still looking better than the market cap weighted S&P. You can see the cup and handle there. A move above 150 would be a nice breakout. What the VIX do today? It's showing up 5%, but actually it traded yesterday. It's not showing on this chart here. It was actually down slightly today if you just look at what it did yesterday versus what it did today, but the net between the two of them is up. The 2 days is up 5%. Ran into the declining 8-day moving average, trending below the 21. That's bullish action on the VIX. How about the dollar? The dollar bounced at the bottom of the range here today. Let's look at what it did intraday. It strengthened intraday, and this is basically the opposite of what you saw going on with the market. So the dollar did show an impact today, and it definitely had an impact on gold and silver, which which we will segue right into now. So with the dollar being up, gold was extended down 0.65. I mean, no significant damage, still trending above the 80 MA. Silver, which had been lagging gold over the last couple of weeks after leading it for a while, down 1.4% on the day. It was the miners that took the biggest hit. But again, they were trending strongly above the 80 MA for 2 weeks. All they did is pull back 3.5%. The 80 MA has flattened that out now, and it's sitting right on top of it. So you could break either way with this one. How about um, how about bonds? Let's go to BND first, the broad index. Get above the 200-day moving average, down slightly today. How about corporate bonds? That's LQD of the 200-day with a mild pullback. JNK, high yield / junk bonds above the 200-day, tight range today. TLT, the 30-year, down 0.65 today. Price down, that means yield up. Let's look at TYX. This is the 30-year yield. Price down, yield up. So that checks out. How about TNX? This is the 10-year bond. 10-year bond yield up also today. And Bitcoin, we stopped talking about it for a while. When you take your eye off something, that's when it makes a move. But we started talking about it again last week after gapping and breaking out of this range above 1150 here. It's moved from 16,000 above 20,000 on Bitcoin itself. This is the Bitcoin futures. That's the easiest way for us to play it on a US exchange. So those are the big ETFs. Let's go to the tail of the tape now. Uptrend with caution, no change there. Already covered all of that. We're toggling between the bull and the bear case. Might be toggling between them for a while, but some news. New York State Manufacturing Index had a huge miss pre-market, down 32.9%. This is the weakest since March 2009. So on the one hand, when you see weak economic data, it gives more weight to the Fed cutting back on the raising of interest rates. On the other hand, when you see a big miss like this, it might imply a hard landing instead of a soft landing. And this is the type of thing that the market has been struggling with to work out. Oh, and it really will be over the next 2 months as we go through earnings season. So the more earnings report, you're seeing some say we're not really impacted. After hours UAL reported very strong earnings and is gapping up, but we saw some this morning, and we saw some retailers that aren't doing so well. So all of this evidence will get weighed by the market. They'll assign a PE to the market. Evidence of hard landing versus soft landing will come out. And as long as no black swans yield their heads, so we'll get some clarification on what's going on. We've got a Fed meeting in 2 weeks. That'll give us some more insight, and ultimately the market will make a decision one way or the other. Two more pieces of news. China GDP beat expectations as the world seems to be looking toward China as the one growth area as they attempt to open back up despite lots of COVID cases over there. On the other hand, Japan yields had a big spike overnight Sunday and overnight into Tuesday. And that's something to keep an eye on because that's not something that they were counting on. The government owns most of the bonds, and it was thought that the yield would be, and the yields are way lower than the yields across the rest of the globe, but something to keep an eye on. Japan yield spiking. So expect the day count. We went from up six to up six with one consolidation. We've been 7 days above the 8 and the 21-day moving average. Expectations coming into today, positive slash neutral. Positive because we're in a uptrend as of right now, short and intermediate term. Neutral because after being up 6 days, we would have expected a pause or wouldn't have been surprised by a pause. And that's what we got with the rotation consolidation day. This 4007 area, the next resistance area, we got above it and failed. On the S&P, we're in this resistance range. On the NASDAQ 100, here's the intraday action, including closing with that 4.5 hour tight base. Sectors today, bond yields up with bond prices down, dollar up, Bitcoin up, and solar up. Those were really the standouts. There weren't a lot of standouts today. Oils started strong, reversed to mixed. Gold, silver, and gold and silver stocks weak. Biotech, XBI weak. PIC, that's base miners weak, and XLB, FI, and C, that's basic materials, financials, industrials, and communications were weak. Here's the focus list. We'll go through these charts momentarily. No trades in-house today. Bottom line, healthy rotation consolidation day after a 6-day up move. Now here's what we need to be watching. Here's the 4007, the next resistance area. That's the 61.8% fib of the third leg down. The market watches these levels. It failed right below here on Friday. Today got above it and reversed back below it. Also close to this is this 39.99 level. That's a major fib level retracement of the entire 2022 bear. This is where we got above it and closed there on Friday. Again, we got above it today and reversed below it and closed at 39.91. So, but on the downside, so those are the two resistance areas that we need to get through. Not to mention that 4,000 area is a round number, and those have psychological importance. On the downside, the 200-day moving average still declining. It's down to 39.78. And this November, December support and resistance area, 39.50 to 39.60. So these levels on the downside are what we need to watch. We've got the 50-day moving average coming up into this 39.50 area. We've got a flat 150-day and a 100-day moving average underneath there, as well as this major support resistance area around 3,900. So let's go back and look at the S&P 500 very quickly. We were talking about this on our intraday call. Now, this rally really didn't come off of a base. It came off of a chop area. This rally came off of a big shakeout after a nasty move down, came up, came down again, and then went up again, and then just went nowhere for 6 weeks, pulled back, but it formed this pretty decent looking base for about 3 weeks before starting to head higher. So this is the first rally off of a low in this bear market that is launching off of some type of a base as opposed to just slingshotting off of a chop. So, in my opinion, that gives it a little bit more legitimacy. We're also seeing much improved breadth in this rally relative to other rallies. We're seeing some stocks break out and go higher. We didn't see that in either of the other two rallies. So far, so good. We're very well aware of the inflationary potential impact on the market if it's not a soft landing, and also if the Fed decides to raise rates more than was expected. So we are very much in the collect the data, digest the data, and react. And the way I'm still playing it is not really wanting to buy strength, more buying the bottom of the range, or very close to the breakout area, but we'll be taking profits quicker unless things really start to improve even more than they are. But certainly, the best last couple of weeks from a leadership and a broad strength standpoint that we've seen. So let's get to the focus list now. And first of all, with what we own in house, uh, geez, come on, Market Smith, AEHR consolidating today. Really been consolidating for about 5 days after this sharp move up. We sold the sharp move up when it pulled back, and then bounced. Didn't even get to the ADMA. We re-entered it. Don't want this one to get away. This has leadership, quality fundamentals, and price action. Although it is a bit on the thin side, so we do have to limit the size that we will get into it. Biotech had this big breakout above 84. I said don't buy strength, but I did buy this on strength because it had been so flat for so long, and biotechs were some individual ones were uh, very clearly leading. After this breakout, two decent consolidation days. Not a fan of the volume on these last two pullback days. As long as it sticks above the ADMA, we're okay. I am noticing the stochastic rolling over. JP Morgan, all the banks after their negative, uh, initially perceived negative earnings on Friday made major positive reversals on volume. So why we bought JP Morgan. Then today, we'll segue into this, Goldman Sachs with a terrible earnings report. Banks gave back quite a bit, but best case scenario here for JP Morgan, volume lower, bounced at the ADMA, undercut and reclaim that 140 area, which had been acting as resistance. So that's the third individual. And then we own various market indexes, the Dow, the NASDAQ 100, the S&P, and dividend index SDY, which has been lagging on a relative basis lately as, like I said, high beta has been leading low volatility so far this year. If you look at this SPHB, high beta ETF, that's a pretty good looking chart. Lagged for a while, but on the month up 10.6%. Compare that with SPLV. There's the relative strength line there. You see how the relative strength line really led high beta for a while, but now we're playing catch up. This up only 0.8% year to date. On the other hand, the value indexes and the growth indexes, the value is slightly outperforming the growth part of the indexes. So that's a little bit of contra information that we wouldn't expect. So anyway, pre-market, first of all, Morgan Stanley came out, good earnings, gapped up, held the gap, closed mid-range. This is on top of a nice move up off the 50-day on Friday. So from the high 80s to the high 90s in 2 days. On the other hand, Goldman Sachs, this thing was just selling off. There were no buyers at all. Look at the volume on that. 536% above average volume, down 6% on the day. It was down as much as over 7%. If you go to a 5-minute chart here, you can see just the persistent selling off the bat. It gapped down, kept going down. Finally below 345. found some buyers and it closed right around 350. So it did hold the bottom of the base. That's the good news. But this breaks it. This high volume break of the 50-day moving average breaks the chart, and this is an avoid. And the other stocks that, like I said, JP Morgan initially gave up quite a bit and continued dropping in the morning, while Goldman was weak, along with the rest of the bank stocks, but it righted itself pretty quickly late morning and then started trending higher. This is what leaders do, and that's showing leadership quality, and that's why we own it. The other stock, and the thing is that Goldman, with it being a highly priced, does this really hit the Dow? With it being a $350 name, that the only one higher is UNH, and this doesn't have a good chart either. So those two weighing on the Dow for right now, that continues. We'll be moving our Dow money into one of the other indexes. And then the Dow also got hit with travelers today on a warning. This is much lower price at 185, but you can see the wide range on that. It did bounce off the lows, but big volume, 200% down 4.6% on the day, not helping the Dow. Moving on, Tesla. They cut prices. It got an upgrade today. First close above the 21, barely, but going back to late November, trying to put in a bottom here. It's now up 31% since it bounced right at this 100 area over the last 2 weeks. So trying to put in a bottom. Massive volume continues on this one. For solar, the leading solar stock made a higher high and then a negative reversal down 1.4%, but you can forgive it after being up 6 straight days and reasserting its leadership among the solars. Celsius broke a downtrend line last week, made a higher high today, closed mid-range. Again, another leader with good fundamentals trying to assert itself. Chewy, Alex brought this to our attention. Nice move up off the lows, 4 straight tight days now. They reported earnings already, tried to break out after that earnings before selling off, but now recouping itself. I got Chewy packages showing up here constantly for our dogs. Look at the accumulation over the last 2 weeks with the big blue bars on average volume all the time. So we're looking for a big volume move out of here. They've got the fundamentals and they're going to be profitable this year for the first time. So if you're profitable and you're got a reasonable valuation, um, keep an eye on it. Next up, so silver and gold. We already talked about these. SLV, GLD, and GDX. Don't need to touch on those anymore. TMDX, fantastic story. Closing high today. Average volume, we got stopped out below the 50-day of our 1% position. May have to revisit it. I hated selling it when I did, but we always have to protect capital as the job number one, as I always preach. Moving on, another healthcare, GE Healthcare, broke out of this very short IPO base, got above 65, reversed now, finally has an ADMA. What I'm watching for, I kind of want to get into this, but I'm watching for how it reacts to the ADMA. Does it respect it? Does it just ignore the fact that it's there? All stocks have different personalities, and you got to acquaint yourself with the personality of the stock in order to determine what your risk is. So that's GEHC MEDP, former leader, forming this long flat base near the top of the base now, and then pulled back at the top of the base. But again, the market pulled back today. No surprise there. And finally, Kathy, 100 Acre Wood is reasserting her dominance. This is up 18.5% on the month after just absolutely getting decimated. This falls in line with what we said about high beta stocks, also performing well. Now up 7 straight days above average volume. This is part of the G6, and if the G6 is acting well, that gives us the feedback that we need to continue pursuing quality bases and entry points for mid and larger small cap and big cap stocks if they're working. And speaking of one that is working, Nvidia got above the 200-day moving average last week. followed up on that strength today. I love the look of this. Still doesn't report for over a month. These, when they start acting well and institutions are looking to pile money into them, uh, as they did Amazon last week, the Amazon volume was uh, really way above what it had been any recent time, above the 15 to 21 day moving average, pulled back today. Let's see what happens as it comes into the Livermore 100. But after being a whipping boys for so long, these big um, NASDAQ type stocks trying to get their act back together. Apple's back above the 21. We already talked about Tesla. You see there's Apple coming off the lows. Google above the 21, but being capped right now by the 50-day moving average. Meta even coming off the lows, uh, making decent move. I know these things have been beaten down, but if we get participation by these big NASDAQ stocks, that can really push the market higher. Let's see Netflix reports later this week. But after this gap down, after saying that their advertisers could have their money back, they've recovered all that and then some. So see how Netflix acts later in the week. That's going to wrap it. As always, love to hear from you. Don at revereasset.com. Questions about a client, email Dan at revereasset.com. And remember, it's not how much you make in the market, it's how much of that you can keep. Uh, Stick with us here at Revere. We update you every night with what's going on from A to Z. So wrapping up Tuesday, January 17th, this is Don Vandenbord telling it like it is. Nothing but the facts here at Revere. Thanks for listening and have a great day.